$777,000. That's the number a client of mine had hiding inside her business when we sat down together for the first time. She had no idea it was there. All she knew was the business wasn't growing like she thought it should. The business was doing $8.2 million in revenue, and she thought she had a growth problem. She didn't. She had a visibility problem. The money was already there. It's just no one had drawn a circle around it. I want to tell you something, because if you're listening to this, you have probably been told by someone in your inbox this week that you need a new funnel, a new ad strategy, a new tier, a new platform, a new offer, a new launch, you name it. Let me be the first to tell you that you don't. You don't need anything new, but that doesn't sell, does it? It's not sellable for them to say that you have everything that you need inside your business already right now. But I'll tell you the truth. And it's the truth that I've seen over and over and over again in all of my consulting clients. Here's the thing. You've built a real business. You did the hard part. You proved it. You have the team, the customers, the reputation, and the revenue to show for it. And somewhere in the last 12 to 24 months, you started to feel the thing that nobody warned you about. The thing where you're working harder than you have ever worked and the business is not moving. The thing where your numbers look fine, but you can't tell if they actually are. The thing where you stopped being able to take a real vacation or a weekend off and you can't remember when. You just know you're trying to lead, make good decisions that often feel like guesses, and do the work too, because you're not quite totally out of that part yet either. I'm not here to tell you that you're broken, because you're not. You are just running the wrong engine at this point in your business. I'm here to tell you that the next million in your business is almost never out there with new customers, new channels, new products, some kind of expansion. The next million is almost never in that place. It is sitting in the business you already built, in a channel that is already paid for, in a customer base that already loves you, in a habit that is quietly costing you every single quarter. Today, I want to give you a name for the thing that you're sitting on, and I want to walk you through the 4 places it almost always hides. Because if you finished last week's episode and ran the 3 questions on your own business, hopefully you did, you're probably already starting to feel what I'm about to name. You just don't have language for it yet. I have a name for it, and you're not behind. You're running a $500,000 business inside a $3 million one. And by the end of this episode, you're gonna know which version of yourself is running that business. Welcome back to the Sallie Ogden Show. I am so excited you're here for this episode. Let's get ready to go further. Here's what we did in episode 14. We named the engine. You're running the business as one of 3 different versions of yourself. Either the founding self, letting that hustle engine still run the show, the plateau self, which means you're letting busyness of the business run the show, and finally, the liberated self, where you're letting the structure run the show. What's the cost associated with running your business in any way other than the liberated self? I'm going to share that with you in this episode, and it will name the cost. You'll hear it in actual numbers, what it costs to stay outside of that liberated self, in your founding self or in your plateau self, and still running the business without the data you need to make decisions. It's not mindset language, it's in dollars that you can find inside your own P&L. By the end of this episode, you should be doing math in your head about your own business and feeling a particular kind of nausea that is also paradoxically relief. Because if your revenue is hidden in your business, it's not yet liberated. And running on the right engine, it can be found. So here's the thesis. Every business between $2 and $10 million in revenue is running a smaller business inside it, a version that's doing $500,000 to $1 million in real high margin hidden revenue. That smaller business is not on the P&L because the founder Can't see it. It blends into the aggregate. It hides behind a category. It lives in a customer you've stopped looking at. And it's almost always the most profitable thing that founder is doing. I call it trapped revenue. Trapped because the money is already in the business. It's not theoretical. It's not future. It is already paying you, just at the wrong scale, with the wrong attention inside the wrong container. But no one is telling you to go find this asset and pay attention to it. So you think you're behind on growth, behind on the next million, behind on what you thought you'd have built by now. Every coach in your feed is telling you the answer is more revenue, more hustle, more team, more marketing. Here's the thing, you are not behind. You are running a $500,000 business inside a $3 million one. You have actually already built two businesses. The $3 million one you see and the $500,000 one you don't. The work of the next 90 days is not building a third business. It's finding the second one you've already built and treating it like the asset that it actually is. Now, I'm sure you're wondering, what in the world, how does this exist in my business? And I don't even know that it exists. 3 reasons the trapped business stays trapped. And none of them are your fault. All 3 of them are structural. I want you to hear that twice. None of them are your fault. All 3 of them are structural. The very first reason is your financial reporting is aggregated, meaning you've got 2 areas of the business that are mixed together. Revenue comes in under 1 or 2 line items. Wholesale and retail get pooled. Discounts get pooled. Channels get pulled. So the customer segment that is doing $500,000 in high margin business and the customer segment that's doing $3 million in low margin business show up maybe looking the same, like they're the same business. And they are not the same business. They are 2 different businesses with 2 different economics and 2 different needs. But you can't see them as separate, so you run them both the same way. And the smaller, more profitable one suffers because it gets the same exact operating attention, if not less, than the larger one. And here's the part nobody told you when you set up your books. Your books were built for taxes, not for management decisions. Your bookkeeper is doing exactly what he or she was hired to do. Keep you compliant, keep you audit ready, keep the IRS off your back. But none of that helps you see the smaller business hiding inside the bigger one. That is a different job, and almost no one is doing it for you. So reason number 2, your attention follows your revenue. You spend your time on what is already big, and that's rational. That's what a founding self does. The version of you that built this business from 0, you watched the biggest number because the biggest number is what kept the lights on. But the trapped business is by definition smaller in revenue terms right now. So it gets the least attention from the person who could grow it the most. And the math is brutal. Your highest margin customer segment is getting the smallest share of your calendar, and the segment that is loud and demanding and lower margin and harder to serve is getting most of you. You're not failing at attention. You are succeeding at the job you trained yourself to do. The problem is the job changed and nobody told you. See, it's easy to look at the biggest clients and think their volume will continue to grow. But frankly, the growth on those big clients now might only be minimal moving forward. And the largest growth can and will come from your much smaller clients. But since they're small right now, they don't get any of your attention because you're so focused on the big guys and making sure you don't lose them. Reason number 3, the trapped business does not announce itself. It doesn't call you. It doesn't complain. It doesn't show up in a meeting. It is by design the easy customer, the one that buys without being chased, the one that pays without being reminded, the one whose order comes in clean and ships out fast. No one has to do anything special, the one who doesn't try to negotiate on their terms. This is exactly why you stop seeing it. It's the quiet third of your business, and the quiet third of your business is almost always where your next million is sitting. You worked harder than you've ever worked, and you cannot tell why the numbers will not move. The reason is not effort. The reason is structure, and structure is fixable. As I mentioned at the start of the episode, a few months ago, I sat down with a founder of a business doing $8.2 million in revenue who had a beautiful brand, loyal customers, 75 plus years of reputation. From the outside, the business looked great. From the inside, she was tired. The growth had flattened and she knew there was a next level. She just couldn't figure out how to get to it. I want you to hear how she described it to me because I think you might recognize it. She said something like, I don't think I'm doing anything wrong. I think I'm just doing too much. I'm doing 4 jobs and I feel like I'm not doing any of them well. And I can't tell what is actually working anymore and what's not worth my time. If that sounds familiar, this story is for you. She told me on our first call that she had about 1,000 designers in a customer base. And that's what she said, about 1,000. That was the number she was running off in her head and running the business off of. When we pulled, though, the actual data, she didn't have 1,000 designers. She had 2,739. 2,739. That's almost 3 times the number she thought she had. So the first question I asked was, where are the other 1,700 that you didn't mention? And the answer was they were dormant. 58% of her designer customer base had bought from her at some point and stopped. Never been called back, never been re-engaged, never put on a single email sequence that was designed to reactivate them. That is 1,577 designers who had already proven that they would buy from her, sitting in her customer database, and no one was speaking to them. Nobody at her company even knew they existed at that scale. The business was running a $3 million business inside an $8 million one. The 500,000 version of her trapped business was literally 3 times that size. Now, I want you to stop me for a second and ask the question I know that you want to ask. Did she know? And the answer is no. Not because she was avoiding it, because nobody had drawn the picture for her. She had been the only one looking at everything in her business, which meant she had also been the only one trying to fix it. And there were not enough hours in the week for one person to find the picture inside aggregate reports. That is the part I want you to hear. She was not failing. She was just the only one looking. The reports she was getting from her CFO too were things like her overall P&L, her balance sheet, and cash flow statement. All relevant for running the business, but not for making strategic decisions about growth and where to direct the sales team to spend their time. So here's the second discovery that we made. I asked her about her top 20 designers, the biggest accounts, the ones doing the most revenue, averaging 97 orders each. And here's the thing, she didn't have a top 20 list, not because she didn't care, because her business wasn't structured to make designers their own thing. They were lumped in with small boutiques and independent retailers, with anyone else placing a wholesale order. Same sales rep, same follow-up process, same email cadence, same priority in the queue for all of them. A designer doing $50,000 a year was getting the same service experience as a boutique placing a one-time $300 order. That's not a sales problem. That's not a marketing problem. That's not a product problem. It's a structural one. Her highest margin customer segment, the one doing 49% gross margin in a business where the rest of the wholesale book was running at 28% margin, did not have its own sales lead, its own marketing person, its own follow-up sequence, its own loyalty program, its own dedicated rep, or its own dedicated dashboard. It existed inside her customer file. It did not exist inside her org chart. So when a designer placed a first order and didn't come back, no one really noticed. No one followed up. There was no campaign designed for them. So we pulled the data and found 896 designers, yes, 896, who had placed exactly one order and disappeared. And the kicker, when her team went to High Point Market that fall, designers walked up to her booth and said, "How do I not know about you guys?" These were designers in her customer file. Designers who had already bought from her. Designers who didn't know she existed because nobody had built this engine to talk to them. They had been talked to as wholesale accounts. And Designers do not buy the way wholesale accounts buy. A wholesale account is transactional. A designer is relational. A designer wants to know who is going to call when their project lands. A designer wants a lookbook. A designer wants samples. A designer wants someone who treats them like a designer, not like another order in the queue. She didn't have any of that. Not because she was a bad operator, because the busyness had grown past the structure that built it, and the structure had never grown up. The most profitable channel in the business was the channel with the least dedicated infrastructure around it. That is the trapped revenue. The whole channel. 49% margins, sitting unattended on a sales team built for 28% margin work. When we ran the math on what those findings represented, the picture got bigger than she ever could have expected. The whole business was doing $8.3 million in revenue. And inside that 8.3, we found a path to roughly 11 million. Not 11 million in new customers, not 11 million by entering a new market or having to launch a new product line or spending millions of dollars. 11 million from the customers, channels, and relationships she already had. Designer activation alone was 1.9 million in additional revenue, just from treating designers like designers instead of wholesale accounts. E-commerce, which she had been sort of putting on the back burner, was another 600,000. Her top of funnel was already converting at 1.5%. The industry was at 3%. Closing that gap with the traffic she was already getting added another 600,000 without spending $1 more on marketing. And you stack it all up together, roughly 2.5 to 3 million in revenue she had already earned the right to and just had not yet collected. But here's the number that matters most. Of all the revenue, $777,000 came back to her as profit, not gross sales, not top line. Profit, the kind that pays the owner, the kind that funds the next hire and shows up in the bank account at the end of the year. $777,000 in net profit improvement sitting inside a business that was already there, already paid for, already running, already healthy by any normal measure. That is the chef's table. That is what's trapped revenue, what it looks like when you stop calling it revenue and you start calling it what it really is. Profit that has already been earned, sitting in customers who already trust her, served by a structure that was built for a smaller business and never grew up. That is the most common shape of the businesses I get called into. The founder thinks she needs to go find new revenue. What she actually needs is to draw a circle around the revenue that is already there. And I want to name something for the founder listening. If you have ever stood in front of your numbers at the end of a year you worked harder than ever on, and you looked at the results and felt that quiet thing in your chest that says, this is it, the thing you felt in that moment, that is not failure. That is the trapped revenue you have not been able to see. So the question is not what is wrong with your business, what is wrong with you. The question is, where is it hiding in yours? Is it hiding in a customer type you've been treating like everyone else? Maybe a segment that is doing better margins than the rest of your book, but getting the same service, the same emails, the same place in the queue? I don't know. Is it hiding in a channel that's feeding you for free while you spend all your energy on the channel that takes the most work? Is it hiding in a top 20 list you've never made because the structure to track it never got built? Is it hiding in a pricing habit that drifted, a discount that became standard, a comp that became expected, a yes that became a default? Is it hiding inside an aggregate line on your P&L that no one has ever pulled apart? I don't know which one of these it is for you, but I know it is at least one of them because every plateau self business has at least one. And the work of the next 90 days, if you decide to do it, is finding it. I want to give you the 4 places trapped revenue lives in almost every business between $2 and $10 million in revenue. If you run this list against your own business, by the end of this episode, you're going to find at least one of them, probably more than one. So have a pen if you can and a piece of paper. If you're driving, this episode will be here when you get home. So the place number 1 to look is dormant customers. The customers who bought from you and then stopped. Not the customers who churned with a reason. The ones who just went quiet. The data on this is consistent across every business I've ever audited. Anywhere between 40 and 70% of any customer base that is more than 2 years old is dormant. Reactivating them is cheaper than acquiring new ones by a factor of 5 to 10 fold. And almost no founder under 5 million in revenue has a system for it. The company I was just talking about, the home decor business, 1,577 dormant designers. Another client of mine, a candle business doing about 750,000, had 2,900 dormant buyers and hundreds of wholesale buyers who had purchased from them once and never been contacted again. The pattern repeats. Your diagnostic question is, how many customers in your database have not bought from you in the last 12 months? If you can't tell me the number in under 5 minutes, you have a dormant problem. Go find it. Place 2 is an underfed channel, a channel that is bringing you money today without any of your attention. Almost every founder has one. Sometimes it's organic search. Sometimes it's one referral partner who keeps sending you clients. Sometimes it's a single wholesale account that orders without being asked. The channel works. You have not built any structure around it. You have not fed it. You are in effect leaving money in a bank account you forgot the password to. I had a client doing $629,000 in revenue with $99,000 a year coming in from organic Google traffic. She had never opened the analytics tab. The money was sitting there. Nobody had looked. We did not find it because we were clever. We found it because somebody finally looked. So your diagnostic question in this section is name your top 3 revenue channels. Now, name the one you have spent the least time on this year. That is your underfed channel, almost guaranteed. Okay, place 3 is pricing and discounting drift. Founding selves say yes too often. Yes to customer requests, yes to one-off discounts, yes to comping the freight on this one because the customer is a friend, yes to a payment term that does not actually work for the business, but feels rude to renegotiate. Every individual yes is reasonable. The compounding effect is a margin that drops 2, 3, 4 points a year. Run the audit on the last 12 months of your invoices and ask how many of them have a discount, a comp, or some sort of other custom term on them. The number is almost always higher than you think. In that candle business I mentioned a few minutes ago, it was running at 28% of revenue through discounts. The founder didn't know it was that high, 28%. That is the trapped business hiding inside the small concessions. Hundreds of yeses that each felt reasonable in the moment and added up to a quarter of the company. And I'm not telling you this to shame the yeses. The yeses are what built the trust, that built the business. I'm telling you this because the yeses were a founding self decision and you are not the founding self anymore. You're running the next version of the business. The next version has to be allowed to pick which yeses still serve the business. So your diagnostic question in this section is what percent of your revenue last year was discounted in some form? If you cannot answer that question in under 30 seconds, you probably have a drift problem. Okay, place 4 is a customer segment misclassified. This is the one founders almost never find on their own. A customer segment that looks like one type of customer in the books, but actually behaves like another. So in the home decor company, we were reporting her designer revenue and her end consumer revenue in the same bucket. 2 completely different businesses with completely different economics treated as the same business. When we pulled them apart, the designer business was running at margins that made the consumer business look like a hobby. She had been making decisions about both based on a blended average. The blended average was telling her a story that was not true about either one. So I want you to feel the weight of that one. She was not making bad decisions. She was making decisions on bad data. 2 very different things. And the consequence of decisions made on bad data compounded over 5 or 7 or 10 years, and it creates a flat trajectory. So your diagnostic question is, if you went back and pulled apart your last 12 months of revenue by customer segment, would you be able to tell me today which segment is your most profitable? Most founders can't. And the answer is almost never what they think that it is, or the one that they would guess. I want you to hold one idea from this episode and only one. The next million in your business is almost never out there. It is in here. It is in a customer base you stopped looking at, a channel you stopped feeding, a margin that drifted, or a segment that got blended into an average that hid what was actually going on. And that's not bad news. That is the best news a founder of a $2 to $10 million business can hear, because revenue that is already there is faster to recover than revenue that has to be completely new and manufactured. The customer already knows you. The channel already works. The product already sold. You do not have to convince anyone of anything new. You just have to draw a circle around what is already happening and put structure around it. And I want to say one more thing to the founder who is sitting in her car right now, or walking the dog, or doing the dishes while she listens to this. You are not behind. I know it might feel like you are, because the version of yourself who started this business is still the one running it, and that version is exhausted, and exhausted people feel behind. But you are not behind. You are running a $500,000 business inside a $3 million one. And the next 90 days of work, if you decide to do it, is finding that smaller business and treating it like the asset it already is. You are not broken. You are just doing too much. There is a difference. There is a version of this where 3 to 6 months from now, you have your first real week of breathing room in years, not because you took a vacation, because the business does not need you in the same way anymore, because the money is already there. If you want the 4-place inventory and writing, those questions, the ones I just walked you through, I built a diagnostic version of that you can run on your own business. Send me the word hidden on Instagram, and the handle is @the_brim. Just the word hidden, and I will send you the inventory. It's just a 1-pager, 20 minutes with your numbers, and you will know which of the 4 places that your revenue is sitting in. And once you know that, the next move is an easy part. Okay, now, if you're reading or you're going along with this and listening, and you want something to read in between episodes, I send out a newsletter. It's called Further. The link is in the show notes. Make sure to go and subscribe to continue to get information from me, updates, AI tools, recommendations on things that are going to continue to help you go further in your business. All right, that's the episode. Thanks for joining me at the Sallie Ogden Show. Thank you so much for joining us for this episode of the Sallie Ogden Show. I will see you next time.